The repo market is very simply the place where financial institutions go to swap cash for collateral with each other. If you got to the end of the month and you needed more cash, but you have a car, you'd walk across the street, you'd knock on your neighbor's door and you'd say, hey, take my car, give me some cash, and at some point in the future, I promise I'll buy the car back from you. It's called a repurchase agreement. The car would be the collateral, the cash would be what you're taking, and you pay an interest rate for that loan. So financial institutions do this with each other every single day. They go to each other and they say, hey, here, take some of my US treasuries and I'll take some cash from you and I'll pay you an interest rate on that. I need cash, you get my treasuries, which are the collateral, and I'll pay you some interest for the convenience. Sometimes these loans are overnight and sometimes they're up to a couple of months. Now, in a healthy market, in a healthy free normal market, there is a general balance between the amount of dollars that are wanting to be borrowed and the amount of dollars that are available to be lent out. So if you looked down your average street, you'd see some neighbors knocking on other people's doors, asking for cash, and then you'd see some healthy collateral, some working collateral be offered in exchange. There would be a moderate interest rate. And if ever there was a time where there was more cash needed, let's say 75% of the neighbors all needed to borrow cash on the same night, well, those 25% that had the cash, they'd be able to charge a little bit higher of an interest rate. Just supply and demand. There's just more demand for that product. And if the opposite happens, if there's only one person on the street going up and down knocking, he'll be able to shop around. If somebody's offering a lower interest rate, he's gonna go there. And so when there's more cash in the system, those overnight lending interest rates go down. Now, sometimes there are crises, and there are different kinds of crises. The first one is going to be a liquidity crisis, where everybody needs cash, everybody needs reserves, and there's not enough collateral, or there's not enough good collateral in anybody's possession to get the cash that they need for overnight funding. This is why Lehman collapsed. It's like you look down this street where all the neighbors are knocking on each other's doors saying, hey, do you have cash? Do you have cash? Do you have cash? And everybody's got collateral, but the collateral they're offering is a car, and everybody's car has a blown engine. So it's actually worthless. Well, this is why Lehman collapsed, because everybody was offering collateral. They were mortgage-backed securities. They were worthless. Nobody wanted to accept them. And to anybody who was willing to accept collateral, the interest rate was sky high because there was huge risk associated with that. So you're gonna have to charge a lot in order to compensate yourself for the risk. Again, supply and demand. The same type of liquidity crisis happened in September of 2019. All the neighbors were going up and down the street looking for cash. So this time though, it wasn't a problem with the collateral. It wasn't like everybody was offering cars with blown engines, like why Lehman failed, everybody was offering mortgage-backed securities that nobody wanted. In September of 2019, it wasn't bad collateral, it was just everybody needed cash so bad. Nobody had the cash to lend, everybody had collateral. And so in September of 2019, the repo rate spiked because everybody needed cash, nobody had cash. But the Federal Reserve looked at this and said, we don't want cash to be expensive. We want liquidity easily and readily accessible to anybody who needs it. So the Federal Reserve entered the repo game. They lended hundreds of billions of dollars every night at a lower than what the market would have done, a lower than market rate, so that there would be plenty of liquidity, plenty of cash in the financial system. Now, there's another sort of crisis that's the opposite of a liquidity crisis. It's a crisis where there's too much cash, too much reserves, not enough collateral. Now, in a free market, the depositors or maybe the shareholders would determine how much collateral versus reserves, how much, what the ratio is between liabilities and assets for any financial institution. But in today's world, it's the Federal Reserve that sets these limits.